Hello, fellow students or fellow CA students. Welcome to my first lecture video on financial reporting. In this lecture, we are going to be looking at the conceptual and regulatory framework. There's going to be a series of lectures every week to cover all the areas in the syllabus for you to be able to pass your CA exams with ease. Now, before we go on to look at our first lecture, I want us to look at the lecture coverage. What I'm going to release every week, to make sure you hit the subscribe button so that when the videos are out, you get notified. So we are going to be looking at the accounting frameworks in this video, and then we are going to also be looking in subsequent videos. We are going to be looking at the accounting standards, the IAS and the IFRS. Then we are also going to be looking at profit or loss statement, the statement of financial position, and then we're also going to look at statement of cash flow. And then we go on to look at business combination, that's consolidation, how to consolidate, which also carries a lot of weight in the examination. Then we are also finally going to be looking at ratios, that's evaluation of financial statements. So we are going to cover all these topics for before you go and sit for your exam. So make sure you stay tuned, hit the subscribe button, if possible, share for your friends out there to also benefit from this lecture. Good. Now, the conceptual framework. Now, when we say framework, okay, what do you mean by framework? We are looking at a structure that is in place, okay. So for the IASB, International Standard Board for Account, those who set the accounting standard, for them to develop any standard, they have to follow the framework. It's just like you writing an AC. If you want to write an AC, you have to outline certain items down that will guide you in writing a very good essay. So the conceptual framework also behaves in the same manner. It's a structure, okay, a foundation or principle behind the preparation of financial statements. So for everyone to prepare financial statements, they must follow the framework. Every item on the financial statement follows the framework. So it follows the principle. So there's an underlying principle behind the asset you see on the balance sheet, behind the liabilities you see, the equity, the income and expenses that you see. There's a principle behind it. They don't just appear on the financial statement. Okay. Now the framework provides the basis for developing and applying future accounting standards. As I have explained earlier, future accounting standards are based on the framework. So if there is any standard that is not inconsistent with the framework, then the IASB sits down, then they review this standard and then come out with a new standard based on the framework. Very good. Now, let's look at the coverage of the framework. First, the framework looks at the objectives of financial reporting. Look at the objective. So it makes sense for you to be able to develop an effective standard for financial reporting. There must be an objective. Why do you have to even report in the first place? Very good. So the first objective is to what? Provide useful information. Useful. The key word here is useful information to users of financial statements. So if you are providing information must be useful, okay, for users to make informed decisions. Users have to make what decisions, and you have to provide them with useful information. So the framework takes care of this. Now the framework goes ahead to list the users that we have, the investors, employees, lenders, suppliers, customers, government. They all need a financial statement for their own initiative, for their own agenda or whatever they want to use the financial statement for. So it's your responsibility as an accountant to provide information to satisfy all of these people to take informed or to make informed decisions. Very good. Now let's look at the useful information, characteristics of a useful information. A useful information must contain these characteristics. First, it must be what? Relevant. Must be relevant in decision making. When we say relevant, it means that it should be able to affect the user's decision. So if you have an information that cannot affect the decision of the user, then it becomes irrelevant. It must also be what? Faithfully represented. When we say faithful representation, all what comes to mind is that it must be fair. Whatever you report must be fair. It must be true. And then lastly, it must conform with the standards. If it is not in conformity with the standard, then it's not faithfully what? Represented. Good. If an auditor comes to audit your financial statement and it is not in line with the IFRS, then the auditor will issue a report stating that what your financial statement is not true and fair, meaning it is not faithfully represented. Now, these two are the fundamental qualitative characteristics. They are the fundamental characteristics of what reporting, financial reporting. Then we also have other characteristics, okay, that further improves the quality of what the information that you provide. As you can see, by the comparability, timeliness, understandability, and then what verifiability. A quick meaning of comparability. Users would want to compare your financial statement with your prior year figures. So your prior year figures must be consistent with the current year figures so they can make comparisons. So if you are using an accounting policy in the previous year, you must follow the same policy in what the current year as well. And the timeliness, the information must come on time for them to make informed decisions. If you delay, then it means that the information loses or it's relevant. And then understandability is also key. The framework also assumes that the users have the basic knowledge to understand the financial statement. So yes, financial statement must be in a way that they will be able to comprehend and know what to make informed decisions. And then verifiability. If an independent third party, okay, a knowledgeable independent party like an auditor, if they pick your financial statement, they should be able to verify and state that yes, this statement or this financial statement is true and what fair. Good. So the first two, which is relevant and faithful representation, are the fundamental qualitative characteristics, meaning the financial statement must have these two, and then the rest also comes to improve or further improve the quality of what the financial statement. So I have an acronym that you can use to remember that the F stands for faithful representation, R stands for relevance, the C stands for comparability, U for understandability, then for verifiability, and then T for timeliness. Good. Now let's look at some accounting concepts that we've been hearing over and over again in our class from our SHS time. We have the going concern concept. Good. Let me explain this. When we say going concern concept, it means that the financial statement, you must assume that the company has no intention of ceasing operation. If the company has an intention of ceasing operation, then it will not have to show fixed assets or non-current assets, meaning assets which will be there for a very long time. You can't show that to deceive your users. You must first assume that the company is a going concern, meaning it will operate in a foreseeable future. So based on this, then you can go ahead to prepare a financial statement showing balances for the current and the subsequent years. Okay. So first of all, you must assume that the company has no intention to cease operation. Other than that, there will be no need for what financial statement preparation. There will be no need for you to prepare financial statement in the first place. So if we don't think that the company can operate, then why do we need a financial statement? We don't need it. It means that all the assets you see now become current assets because you'll be selling if it's not going to operate in a year, then it means that you're going to sell off the assets in the business. It means that you are going to sell off everything. Okay, so all the fixed assets now become current assets because you'll be selling them off. That is what it means. Good. Now let's look at the accrual or matching concept. The accrual or matching concept. This tends to confuse students a lot. We have the accrual concept, we have the cash concept in accounting. With the cash, once you receive cash, whether or not the obligation has been performed, you record the transaction as cash received. So, for example, you sell goods to a customer in a particular period of time. Once you give out the goods, you receive the cash. The obligation has been performed, cash has been received, so you can record the transaction. But in a situation whereby you give out the goods, but cash has also not been received. In cash concept, you can record the cash even though you have not received the cash. But in accrual concept, you can record the transaction because the substance of the transaction has occurred. You have given out the goods, you have passed on the ownership of the transaction. So the substance of the transaction has occurred, even though you have not received cash. So you record the cash as the item as well, receivables in your balance sheet. Now your profit and loss statement, you can record revenue because you have earned the revenue even though you have not received cash. But in the cash, you will not record cash. In the cash basis, you are not going to even record anything because you've not received cash. That is the accrual concept. And it must match with the expense. They say revenue and all expenses incurred generating a revenue should be recognized in the same period. An example of what the accrual concept in the financial is depreciation. Now, when you buy an asset, you spend a lot in buying that particular asset. It will cost you. Say, let's say in this last year you bought an asset. Okay, it's an expense to you, and you purchase it in a particular period of time. Good. Now this asset is going to be used, or this cost must be spread throughout the life of the asset. So every year you take a portion of the cost and then you match it to the revenue you have generated in the income statement. So this year I'm going to charge depreciation. So I am matching the cost of the asset, not the entire cost, the portion that I've used for this year. That is the depreciated portion to be used in this year. So you match it against your what? Your revenue. That is why every year we release a portion of the asset as depreciation. The cost is being matched with the revenue. So that is actually what you mean by depreciation, the matching concept. So the cost is being matched with the revenue. If you get that. Good. Then we also have so this makes it easier for companies to measure their performance in a particular period. If you don't match your cost with your revenue, you realize that in a particular year you'll be making profit. So assuming you bought the item, you spent a lot to purchase a machinery this year. This year you have incurred costs, so it means that you are going to be making losses. But next year you start making profit. When you sell an item using the same asset to generate this asset. This year you have recognized what an expense, but next year you use the asset and then you generated some income. So you're only going to record the income in the subsequent year or next year, but you are not going to show the cost. So it will make it difficult. So this year you realize that this year you are going to be recognizing an expense, but the following year you have generated income using that same expense, but you are not matching. So there will be a mismatch somewhere. So there's no match up, okay, in there. Let me make it clear. If you want more, if you want me to explain the accrual concept, because I want to make the video as short as I can. If you want me to explain the accrual concept, you can hit me or just comment and I'll go ahead and explain accrual and then the cash concept of the basically accrual concept makes it easier for you to measure your performance because you are matching your income as against the expenses. You don't incur expense in 1 year and then the cost in 1 year, even though you are using the same expense to generate the income. So the accrual concept should match the revenue and all expenses in 1 year. I will have to produce another video to explain this if you want me to. Good. With examples. Then we also have the consistency concept, which maintaining specific policy or method of recording financial statements. Means that if you use a particular policy, you can't just chop and change the policy. The policy must be consistent. If you are using a policy, the FIFO method of recognizing closing stock, this year you can't come and then be using weighted average. It makes it difficult for users to compare the current year's financial statement with the previous year. So consistent policy makes for comparability to become easier, which is which is one of the qualitative characteristics of accounting information. So consistency makes comparability easier. So for users to compare results prior year and other entities as well. Other entities using different policy and using different policy will make it difficult for us to compare results. Good. Now we also have the prudence concept. Accountants cannot anticipate profit. have to be wise. The accountant cannot anticipate that because you think that, oh, next I'm going to make a profit, let me recognize the profit. No. That is why the inventory, let's take an inventory for example. The inventory should be measured at cost, should be measured at the lower of what cost net realizable, cost and what net realizable value. When you say cost, why is it the lower? Because you if you measure it at the higher of them, you know, you're recognizing profit even before you make them. So the cost is lower than the selling price. So you recognize as the lower. This is to help the accountant. So when that happens, the accountant is carefully providing for the future to prevent surprises. So you don't get surprised when the cost of the item reduces in the future. You have already made provision for that. So you don't get what surprise. So you have to be prudent in your recordings. There are certain items. So anytime there is an impairment, for example, if an asset, the value of an asset reduces, you record the reduced value, and then you make provision for what the loss that has been made. Don't record the higher value. Don't recognize profit before they are impaired. Good. Now the financial statements is made up of the following elements. You have the income, expenses, assets, liabilities. So the first two forms your statement of profit or loss. And it's basically used to measure performance. So if you want to know how a company is performing, look at what their financial statement, how they're able to generate revenue, and then what, how they're able to control their expenses. It tells you how the company is what performing. It tells you performance for a particular year. Good. And then statement of financial position is also telling us the balances, the asset balances, and the balances of your liabilities. So the asset is what you own, what you have in your business, and then the liabilities, what you owe others as well. So asset, so you set up what you own and what you owe others. When you deduct what you owe from what you own, then it gives you what your equity. So the residual value becomes your equity, that's the owner's interest. Very good. Now, how do we recognize revenue? As I said, this is the matching concept. Revenue is recognized when it is earned and not when cash is received. Let me take my time to explain this. When you, example, if you sell an item of goods, once the goods leave your premises to the customer, even without receiving the money, you recognize your revenue. Though the money hasn't, you have not exchanged cash, but the goods have left your possession, so you have no more control over the goods. So at that instance, in your profit and loss or P&L statement, recognize what revenue because you have earned it, even though you have not received cash. But you don't recognize revenue when you have received the cash, but the goods still sitting in your storehouse. You don't recognize revenue. You can't recognize revenue in the income statement, even though you have received cash for it, but you have not performed your obligation. So you don't recognize revenue. If you get that, good. Then expenses are also recognized when they are incurred, not when they are paid for. So if you pay for an expense which you have not incurred, meaning, let me use an example in this situation. You, for example, let's say, let me use electricity, for example. Once you consume electricity and you pay for it, you have incurred it, and that's why you have paid for it. But in a situation whereby you have used electricity, but you've not paid for it here, you will pay for it next month. You have incurred it because you have used the substance of the transaction as okay. You have once you use it, it has been incurred, even though you have not paid for it. So you make accruals the balance sheet. And you record expense because you have incurred it, even though you have not paid for it, record an expense. In a situation whereby you pay for the expense, okay, you have paid for the expense, but you have not actually used the electricity, but you have paid for it in advance, you cannot record an expense. But your balance sheet will have something called prepaid expense. You have an asset sitting in your balance sheet. Once you incur it or once you use the electricity to be relieved from the assets to where your expenditure, so it becomes part of your externality released from there, then it becomes what an expense because you have now incurred it. But once it has not, you have not used it, you have not incurred it. Even though you have paid for it, you haven't incurred it. So expenses are recognized when they are incurred, when the substance of the transaction occurs. If you use it, it's incurred, whether paid or not. Very good. Now, then let's look at the recognition criteria for assets. Recognize assets when the future economic benefits will flow to the organization. So in the balance sheet, all the items you see as assets means that future benefit will be flowing from that. You'll be getting benefit from your PPE, property, plant, and equipment. You're getting future benefits from them. Your stock, receivables, you will be getting future benefits from them. Just that the period of time is what makes us separate non-current assets from what current assets. Some you'll be getting a benefit within a year, they form what the current asset. Unless you'll be getting a benefit in more than a year, they form what non-current assets. Good. So if you receive benefit from it, then you control the asset as well, then you can recognize that as an asset. If you don't control and you're not going to receive future benefits, you can recognize it as either an expense or whatever you want to recognize based on what the recognition criteria. And then the cost should also be measured reliably. If I don't know the cost, why do I put it on my balance sheet? Why do I have to put it on my balance sheet? There's no need. So you don't know the cost of an item, why do you have to show it on the balance sheet? No. So for an asset to be recognized, you must control the asset. So an asset is a resource that is controlled by the organization from which future economic benefits will flow to the organization. Good. And then liability also same as the asset, but this time around liability, you're going to be making future economic sacrifice. So an outflow of economic resource. Liability you owe others, so you have to pay them. So anytime you have an obligation to pay someone, you recognize what a liability, an obligation, meaning that in the future you are going to be losing resources, so it becomes a liability. And then you should be, the cost also should be measured reliably. The same recognition criteria, just that for assets, benefit is coming to the organization, and then for liability, they're going to be making future economic sacrifice. There will be an outflow. Very good. Let's move on to how do you measure the cost that we are saying? We are saying that the cost should be measured reliably. And yes, the cost, you should be able to measure the cost. So we have in the framework provides various ways of measuring the cost. We have the historical cost. So if you have an item of plant, such as PPE, plant, property, and equipment, you can measure it at its historical cost, the cost or the purchase price, the cost you pay to acquire the asset, good, or the current cost. So you purchase the asset 2,000 years ago at a particular price. That same asset you purchased currently would have a different price due to inflation. So you can either record the asset at its historical cost and depreciate it over time, or you record it at its current cost the price of an item now, an item that you previously purchased. You can also record it at this that same item. Okay, how much it will you will receive if you were to sell off the asset, how much you will receive. That is the realizable or settlement value. So you can either also record it at its realizable value. So that same asset, either you record it at its historical cost, the framework makes that's available for you. So it's a policy you also have to adapt. But either you measure it at its historical cost, or that same asset, how much it will cost you now, or how much it will if you receive, if you have to sell the asset, the framework allows you to measure the cost of the item using all of this. And then the present value of the asset. When we say present value, so if you have an asset, it's going to generate future economic benefit. So the future outflows, you discount all the money you'll be receiving in the future. You discount all of them, okay, down to the present value. It will give you the cost of the item, that is the present value of the future economy, the future estimated estimate of present discounted future net cash flow. So the money is you have to estimate that you'll be receiving say 2,000 every year from this asset. So you discount the 2,000 for the number of period that you think that you are going to be generating this income. That becomes the present value. So all of these are ways of measuring cost. Then let's look at the regulatory framework. Good. Now, regulatory framework, we are talking now, we are dealing with the bodies responsible for the production of what financial reporting standards. So the IASB, the International Accounting Standard Board, how do they prepare the standards that we have? The IFRS, the IAS, how is it prepared? First, you have to identification of area where standard may be needed. So you have a body that's always go through the review the standards and then they identify areas where standards may be needed in the financial statement to provide useful information to users, which is very, very, very important. So after identifying, and they develop a discussion paper, okay, for the public, or they even they have groups, okay, groups that will discuss the issue, the topic at hand. When they discuss, then they review their discussion, then they develop and publish what an exposure draft. So they draft, they first have to draft one standard and then put it there for the public to comment on this standard that they have drafted. They receive comments from all over the world or stakeholders. They receive comments from all of them. Then, after reviewing their comments, then they issue the final IFRS for us to use. So it goes through due process. So they don't just come out one day and then release an accounting standard. It follows this due process. So basically, this is it. I want you to take the textbook. You can take the ICA, your ICA manual, go through, read, and then solve some past questions. Get the past questions on the conceptual and regulatory framework. Solve more examples, and then I believe you'll be fine. Thank you for watching, and watch out for my next video, which is coming in a week time on IAS, the accounting standards. I'm going to release IAS 1, that's first let me take the inventory. I'm going to release a video on IAS 1, IAS 2. So stay tuned. I'm going to release a video on all the accounting standards that will help you pass your exams, your paper exam. You just hit the subscribe button, and I can assure you that after going through this lecture video, you'll be okay. Thank you for watching.